with headwinds and volatility sometimes becoming an obstacle for players in the business and economy landscape. Watch Business Point on Global Television as Samuel Oji walks you through the twists, turns and curves in bonds, stocks and crucial market indices from a global standpoint. Watch Business.
Hello everyone and welcome to the program Business Point on Global Television. I am Samuel Odi. Many thanks for joining. On today's edition of the program, we'll be looking at stock dynamics and the impact of the new interest rates on the markets. From last week, Business Week, obviously, if you've been following the trend, we witnessed a significant growth in the stock markets where we witnessed growth on a daily basis throughout the business week last week. But fast forward to Monday this week, we still witnessed a significant growth. But down to Tuesday, a negative terrain happened. The Nigerian stock market closed in the negative territory on October 8th. Now, lots of persons have been asking questions. Before we get into the questions that people were asking, let me bring you up to speed with what has been happening in the stock market. Let's just say from this week, the Nigerian stock market closed in a negative territory on October 8th. That's as all the share index slipped by a minus 0.12%. The ASI dropped by 121.89 points, settling at 97,584.81 points, despite a significant increase in the market actively with 719 million shares traded, up from 308 million shares the previous trading session. Strong gains were observed in the week lines and also PZ as cousin babies throughout the day, while WAPA and other several banking sector stocks led the market in trading volume. So let me just bring you up to speed with the market summary from the previous market. The current ASI is at 97,548.81 points. Previous was 97,706.70 points, which is a day change of minus 0.12%. Year to data performance is at plus 30.51%. Volume added is at 719 million shares, a total deal of 9,435. So this is what happened. So a lot of questions are being asked. Now we are at the point where questions are being asked. The CBN governor increased the monetary policy and then tightened the monetary policy and then increased the interest rate. Now it's at 27.25%. It's been alarming because now, before this increment was done, we witnessed a significant growth in the stock markets. Now this increment has been implemented by the CBN, and now we are beginning to witness a decline in less than a week in less than 4 business days. So now, what does this even tell us in the next 2 days or in the couple of months to come? How key is it that this regulation is going to help the stock market grow? It's going to help the economy grow. And the main focus of increasing this current interest rate was said by the CBN governor that the long time goal is to curb out inflation. We're witnessing a downtime, a decline, a dip in our stock market. So if the stock market is getting deep, how can inflation be curbed out when people cannot be able to borrow money? And we are getting to the festive period, and we all know how festivities happen. The fact that and we wouldn't be having much money in circulation is another angle of the conversation. But we're going on a quick break. When we return back, I'll be introducing my guest, who is a financial analyst who help us extract these angles of conversations while we understand what is actually going to be happening in the business world within the next few days. Please stay with us. We'll be right back. Yes, many thanks for staying with us. At this time, I'll be introducing my guest who is joining me virtually. Good morning, Mr. John Ochai. Mr. John Ochai is a financial analyst and has knowledge about all that is happening within the financial sector. Mr. John, can you hear me?
Yes, I can hear you. Good morning.
Yeah, good morning. So
Good morning.
as we get into the we're about to get into the conversation and to figure out, what's your reaction to the monetary policy being tightened and the current increment in the interest rate?
First and foremost, good morning for inviting me.
I don't know if you can hear me.
Yes, I can hear you loud and clear.
Okay.
So, thank you very much for the privilege given to me. I was supposed to be in the studio, but due to tight schedule, I couldn't make it there. But nevertheless, let's x-ray based on the question that you have asked. Yes, tightening the monetary policy, the government may have their reasons doing that. But from the perspective of financial applications, there are some certain things that we need to look at before taking such kind of decisions on what we are doing currently. And I believe with what we are doing currently is overshooting the mark that is going to hamper a lot of businesses and is going to affect majorly our economy. Because when you look at the reason why the markets are falling in a situation where there is no equilibrium between the dollar and the naira, and then we even place value more on dollar in favor of naira, then we begin to have multiple problems. One of the reasons why sometimes we have a deep fall in the stock market is that when we don't have enough liquidity in the economy, it's caused a lot of friction. And what that means is that money are not circulating as such. And when you dip in by tightening the monetary policy, such as a high interest rate, what means is that a lot of businesses that doesn't have enough of sinking fund that depend on borrowing for them to transact their businesses will no longer have access to credit advances. And when they don't have much on the credit advances, putting the business at risk, they will look elsewhere. And looking elsewhere, and it's not as easy, because when you look at friends, family, business associates, they don't have such kind of money to be given to such kind of businesses for them to trade as usual. Then second aspect why we have such kind of problem is that when you tightening in thinking of future inflationary measure and you are not thinking about the implication at now, it will definitely have a ripple effect. When you tighten the monetary policy by giving a high rate, just as the borrowing rate is at 30%, and then when commercial bank and other financial institutions borrow from the bank, what that means is that they are also going to add operational costs and other charges inclusively, which will overshoot the interest rate between from the bank to the commercial bank to the companies that they are firms and institutions that borrow from the bank or financial institution. And what that means is that there is not much liquidity, because the liquidity that is supposed to circulate within the economy is no longer circulating because it's over-bloated. Then there is a high expectations of mismatch leading to stock decline. What that means is that, for instance now, when you have a 30% benchmark target, and at the same time, and then you have a mismatch of 20%, which means there is a tier that grids the traders in the market. So when there is such kind of a tier, then it leads to, then declining the kind of putting much, much in the system. Then we have business outlook that are not rosy now. We have inflation doping the Nigerian economy. We have a lot of not having access to credit advances, and then we exchange rate FX is dipping, because the exchange rate between the naira and dollars now is really galloping. And then when you put all those things in view, it makes the business outlook in Nigeria not so rosy, which will make Nigeria, leading to Nigeria Stock Exchange into a stumble. Then overshooting also leading to the stock fall. And we put all those things into places, you realize that, yes, the decision taken by the Central Bank of Nigeria, then they have reason, based on what you have said in the long run. But if you are putting a long-time measure, you have to also look at the short-time measure, so that both will complement each other, not looking at the long-time measure and then put the short-time measure at risk, just the way we see a lot of decline in the stock market in yesterday.
Interest rate is one of the reasons why we are witnessing this dip in the stock market.
Yes, we know it's not just only interest rates. Mm-hmm. We have different kind of issues around. Interest rate is one of the issues, because when the borrowing rates from the central bank is high, definitely the borrowing rate from the commercial bank and other financial institutions will become so high, meaning you are putting the business into a tough position. And putting the business into a tough position, automatically the needful will not be done in the right direction, because many businesses that are supposed to strive will begin to fizzle out because they cannot meet up with their operational and model. And when they cannot meet up with operational model, they will definitely fizzle out of the market. And when they cannot meet up with the requirement, what that means is that a lot of people are going to resell off their stock to another person. And when there is no much liquidity in the system, it poses a lot of challenges. And then we have inflation. Inflation is around the corner. We all know in Nigeria today that Nigerian inflationary measure is on the high rising. Food inflation is on the high rising. And for what that means is that the companies have a huge amount of money chasing some few goods, meaning the government, the firms are unable to trade as much as they can, because they have to also look at the risk factor and risk major that is attached to those trading. And then if they put their money in stock and they cannot have enough to enough profit to come back, then they may decide not to even trade at all. And that is exactly what is happening. That investment into trade or the value added to the trade are lesser than that is the input are lesser than the output, and that is the issues surrounding the whole thing that you see a lot of decline in the system that we are experiencing as right now, because Nigeria economy outlook is not really rosy, and every organization look at the risk factor and then think of what to do for them not to, have a losses. And for them to also cut their losses, they have to also think of their risk factor and then determine what to do to diversify from different directions, not looking only towards the stock market.
Interest rates and monetary policy being tightened and interest rate going up is for a long time goal for us to be able to curb out inflation. The festive period is around the corner. Way before we have this high level of inflation, around this time in the year, usually items, food items, clothing, everything usually goes up, due to the festivity. So you rightly mentioned about a short-term goal. What short-term goal do you think can be in place to be able to curb out inflation and then, help people have purchasing power to be able to buy stuff during this season?
All right. The truth of the matter, financial access is not something that we just garbage in, garbage out.
Mm-hmm.
We have to look at the mechanisms put in place to see what are the measures. So if you are putting a measure, you don't have to tighten where you see tax is on the high, rising interest rate is on the high rising. What that means is that in the fiscal point, you are tightened the economy. In the monetary point, you are tightened the economy. What that means is that you are locking up the system. And when the system is locked up, automatically it becomes so difficult for every person, both the trader, both the firm, both the economic entirely. What that means is that it makes the economic so flaccid. So what they should have done is to look at the fiscal aspect and relax on certain taxes imposed on certain goods. And once that is done, then it will now complement the existing high interest rate that is on the threshold now.
Okay. All right. Looking at those angles now. Okay. There are obviously, major challenges facing Nigerian food insecurity. That is a whole lot of challenges around our sector in terms of the food inflation rate, which is at 40+%. How does this affect now farmers who are seeking to take loans to be able to, get into the farming, and how has it been impacting? How is it going to impact the SMEs and borrowing power moving forward?
Moving forward now is difficult, my dear brother. Mm-hmm. Borrowing rate is high. And if you look at the farmers, Nigeria's system of farming is seasonal. And if the farming system is seasonal in this part of the world, it means that when you borrow or you lend to the farmer or give a credit advance to the farmer, you need to give them a grace period, which is a moratorium. But you understand with me that in Nigeria's system of practice, there is no moratorium given in this part of the world when it is short-time loan advances. For instance now, the commercial loan is not beyond 2 years. And then if the loan is not beyond 3 years, what that means is that when a bank issue out a loan to the farmer, it is expected that after 1 month or 2 months they should start paying back, because they need to recoup those loans within interval of 1 year. And what does that mean is that a farmer who doesn't have any other means source to fund the farming, cannot borrow from the bank to add to the business of farming for that period of time, because when you farm in the rainy season, you harvest in the dry period, then you now dry to start taking it to the market before you start recoup, you sell and recoup. And now government don buy back those farm products from the farmer. And then if government will be able to put a mechanism in place that okay, we'll be able to give a grant to the farmer, let them farm, and then we'll buy back from them, so that if they go to the bank, they will be able to offset their loan without having any encumbrances. That can be achievable. But if you look at our part, this part of the world, or the system put in place, such mechanism is not in place. So it will be very difficult for them to have such access to such facility to invest into their farming system. So until we begin to look inward and look at the issues surrounding increasing, raising the fiscal policy and raising the monetary policy, once those things are x-rayed by those who are saddled with the responsibility, I think it will do us good if we really sit down and think better than what we are doing now. Because if you look at every firm are crying, the informal sectors are crying, transportation sectors are crying, the health sectors are crying, the tourist sectors are crying. Every aspect in this economy they are crying, because when there is no much liquidity circulating in the system and there is no measure put in place by the government, and then it becomes so difficult for we to strive economically and business-wise. So I hope if they relax the tax and then impose on those goods within those periods of UTI, and then it will complement, and then prices of goods will fall in the market, and then it will reduce the inflation a little bit.
Yeah, as we wrap up in 2 minutes, just what's your take, or what advice, financial advice, do you have now that would help curb out inflation for the long run, aside tightening the monetary policy and increasing interest rates?
Over time, why we are tightening up the fiscal policy and the monetary policies is because there is not much liquidity, and the federal government is trying to raise money to begin to think on the directions of the capital project. But as it is right now, all the measures put in place, some work, some doesn't work. At this point in time, I would advise that government should look inward and look inward holistically, so that they will be able to diversify the economy holistically, so that they will be able to look at the sectors that are productive, and then they will be able to give grant to such kind of sector. And then individually, those who keep money in the bank and look at the short measures of investment, they should diversify their funds so that they will not just only focus on the residual income for productivity, but then look at the aspects which will be more productive, and then take it for more money to be in circulation. And then there should be an opportunity for government to repatriate some funds from abroad, so that we have enough dollar in the system to a little cushion the exchange rate issues that we have at our disposal. That will solve the problem.
All right. Thank you so much, Mr. John Ochai, financial analyst, for taking our time to join us on today's edition of Business Points. We really appreciate you.
Thank you very much.
And that's how much time will permit us to take on today's edition of Business Points. My name is Samuel Odi. I'll see you all again tomorrow as we x-ray other angles of business. Bye for now.